Now let's continue the change in working capital. Working capital is calculated by current asset minus current liability. When the company increases the working capital in current asset, that means that the cash reduced. So the working capital calculation is current asset and current liability, but we don't have current liability information here, only the accounts receivable and inventory. If we increase the accounts receivable, that means we recognize revenue on credit sales, but it is not actually cash in. That's why we have to decrease the cash amount when we increase accounts receivable. Inventory means we purchase inventory like the direct material, direct labor, a working process is also part of the inventory. So in this case, the 70% as fraction of sales of the current year is accounts receivable, which is working capital in current asset. And then inventory as a fraction of the following year's expense. The reason why we assume that the 15% of the following year's expense, like a variable cost, the fixed cost, is that we assume the inventory, direct material, direct labor, working process still on hand, and then there will be used for the finished goods to sell. Okay, so we just set up this 15% as an inventory on hand. So let's calculate working capital. So 17% times current year sales and revenue. As of today, we don't have anything, right? We don't have anything. By the way, we need to fix this 15%, 17% times the revenue, and then 15% with the fix times. Now the variable next year variable cost plus the fixed cost, right? Again, that is the inventory still on hand, have not yet sold, but we are going to sell this inventory once we finish it, manufacture finished goods next year. Okay, then the 1500 is working capital, which is cash down, cash out. Then let's just drag to the right so that we measure like this. We don't have the sales. We assume that we don't have sales revenue and fixed cost or variable cost for the year 6 because we assume this project will finish with the useful life of the invested asset 5 years. So the last year working capital end of year 5 is 0. You have to remember always must be 0 in this case, as well as other the projections as well. Cash flows of changes in net working capital. Net working capital. Again, this is the free cash flow is only the incremental changes, incremental cash in and out based on only because of that project. Okay, so if we increase working capital today, this is minus. We increase working capital from year today to year 1, so increase the amount of the increase is the cash out, right? So we drag to the right. The last year it has been increased, so accumulated working capital is 4,721. So 4,721 at the end of year because the decrease the working capital, which is cash in. So as you can see that the total amount is 4,721 as an accumulation, but last year is 0. So the cash flow changes in net working capital is 4,721. So the sum of all these changes in working capital automatically 0. Okay, so you need to remember. Okay, then we completed all this necessary cash flows. Capital is the expenditures, investment today, and then we sold this the fixed asset at the end of year 5, which is useful life with the service value, and need to consider the tax. And then all this operating cash flows from the investments generating this revenue and all the cost. And then add back depreciation is one of a big part of the cash flow because depreciation is not actual cash out. So we got the operating cash flow, and then the working capital, only incremental changes. So let's sum up these three element cash flows in fixed asset, operating cash flow, and then cash flow of changes in working capital. Then let's drag. So we got all this, the cash flows. So based on this present value, based on this projected cash flow, we can calculate the net present value. How do we calculate it? Okay, NPV, where is the discount rate? 12%. And then let's take this future cash flow only from year 1, not including year 0. And then we put this initial investment, right? So that we got the net present value, 5,098. So definitely we take this project. Net present value is greater than 1. How about IRR? Once this NPV is greater than 1, greater than 0, this IRR should be greater than discounted rate 12%. So how to calculate IRR? We include all these cash flows, including initial outlay, 11,500. And then we got 24% IRR, which is very acceptable because it is higher than the discount rate, 12%. Then PI calculation, NPV, once again, the rate, and then let's drag one more time and divide by initial investment. Let's remove the minus because we want to get the ratio. There's no ratio minus. So 1.44 is the profitability index. Okay, the higher than 1 means that, oh, it is profitable. How much? 44% more. Discounted payback period. When we are going to take our initial investment back, how long does it take? How long does it take to recover this 11,500? In order to measure this discounted payback period, we need to get all this future cash flow, projected cash flow as a present value, right? So we got this each cash flows divided by 1 plus discount rate 12%, to the power of 1. Oh, where is it? This number should be shown. Okay, then let's drag it to the right. Then let's get cumulative present value of projected cash flows. So this 11,500 will be covered by $1,000, 1,000 million, whatever. And then the remaining initial outlay is 10,431. The second year was the same way, right? And then let's just drag to the right. So we can recognize that it takes at least 4 years, and then we can make it turn to positive. That means that between year 4 and 5, we are making turnover of this 11,500. So how do you get this number of period? At least 4 years required, plus now this amount should be this amount should be removed, the certain portion out of year 5 present value of projected cash flows. So we got 4.26 is discounted payback period. If this if this project require at least 4 year discounted payback period, this project should be revised or rejected because it takes 4.26 years. But if there's no kind of other information, yeah, this is definitely acceptable because the net present value is higher than 1. Okay, this case is very simple because you guys get all this, the input information is already given, but the most project provides some kind of descriptions or kind of explanations of initial investment or useful life. You need to fill out that the intermediate input procedures, okay, in the real life, the real life the project work. Okay, see you in the next video clip, guys. Bye bye.